We're at home, Teen.
Yes, we are.
So we had a video that we did for early retirement,
We did.
and we'll put a link to it round about here on this video. And that was very much a broad overview, wasn't it, Tina?
Yes, basically it was how to retire early with financial freedom.
And we touched on the FIRE concept, financial independence, retire early, because that's what we did, retiring at 55. So we just kept it very broad, and so we thought we would add some more detail to it. We did talk about saving 10% of your income as it came into your bank.
Yes.
So you would set up...
like a standing order or direct debit or something?
That's right. So it would go out of your bank account and you wouldn't even miss it after a few months.
No, I know when we did it, Norm, we got very used to the fact that it was gone and we just lived with the money that was left, didn't we?
So back in those days, and we're talking about the mid-90s, mutual funds were pretty much what everybody invested in Canada, especially people who weren't financially savvy like us. But today's a whole different world to what it was in the mid-90s, and so we thought that if you were saving 10% of your income, which is a good start, whether you're 20, 30,
you can do it at any time, really, can't you?
set up that direct debit out of your account, and we kind of like the index funds. They've done pretty well over the last few years, and it would maybe be a good place to start.
Mm-hmm.
So we're a fan of dollar cost averaging. So if you could maybe take a look at something like the Vanguard Index Fund, whether you want to track the S&P 500 or another index, and see if you can set up an account that will buy the units of that index fund on a monthly basis, which will give you some dollar cost averaging. So we've all lived through the COVID-19 virus.
Yes, we have.
And what happened to the financial market with that?
It kind of crashed downwards, didn't it?
It did.
Unfortunately.
So in the middle of March, if you'd been saving regularly, you would have taken advantage hugely of that dip in the market. So in that particular month and the months following, you'd be buying more units in that index fund.
So that was one slight advantage to it, wasn't it?
So we're kind of liking index funds at the moment. It's a good way to start. If you are very young and you're financially savvy, then perhaps you could open a self-directed account with an online broker house where you can get cheap trades. Trouble with that is each trade is around $9.95 in Canada. I think it's $4.95 in the US. So it is going to cost you quite a bit to do dollar cost averaging. That's why we kind of like the index fund, to see whether you could do that. So what's next on the list for us to flesh out on this retire early?
It's online banking. And this is something that we are now quite familiar with, because we were looking for places to get a higher interest. And what we noticed was that the banks in the high street were offering absolute pittance, really, really small interest.
Below the rate of inflation. So
we started to look elsewhere, didn't we? And we came across 3 or 4 major online banks, because they don't have the bricks and mortars that the others do.
Yeah, no bank branches, no bank machines.
And a lot of them are insurance companies or credit unions, aren't they?
That's right.
And what we're finding was that the interest was a lot higher.
We were getting around 3% on the bank that we were using.
Yeah,
it was all totally online.
Yeah, it was great.
But you can link your regular bank account from the place where you have your paycheck paid into, and so you can transfer between the online bank and your regular bank, and the funds show up within 24 to 48 hours.
But the benefit is that you're going to get that extra interest. Now it has dropped now because of COVID and everything.
Rates are going down.
Rates are going down, but it's still way better than the high street banks, isn't it?
I think we're around 2 points.
It's around 2%, I think, at the minute.
Right.
But we were 3 or 3.2 when they first opened.
And we do think that if you're retired like us, it's handy to keep a good amount of your money in cash. Just because of things like this COVID-19, where the market has dropped substantially. So we do have cash as well as stocks and other financial instruments.
Yeah, we seem to have a very balanced portfolio, don't we?
But we would highly recommend online banking. Not the regular banks like the Bank of Montreal or Bank of America,
no.
But these new internet-based banks that are generally insurance companies that are setting them up. And they're still in Canada, guaranteed by the deposit protection from the federal government, providing you don't have more than 100,000 in the account.
That's right.
So we feel very safe with it. We're getting more interest. It's at least double what the regular banks pay, and it's just handy to park some cash there.
And then another thing, Norm, we were going to talk about was you'd mentioned about the bank stocks and another way of investing your money possibly into buying stocks.
Well, imagine this, you've got a suitcase full of money, so you go running down to your local bank branch that you've banked with for 20 years, just because you're comfortable with them and you've got your bank card and your mortgage and all your other debt with them. So you take this bag of cash down there, plunk it on the counter and say, I want to invest this in a cash account, what's the interest rate? And it's nothing.
It's so small, it's not even a dot, is it, on the piece of paper?
It's incredibly poor. And on top of that, you're paying bank fees.
Yeah.
Now imagine this, you go online, you find yourself a discount broker. If you're in the US, as we've said before, you can trade for around $4.95. Canada, it's around $9.95. So you go to that same bank that your paycheck goes into.
That you get no interest on.
And you look at the dividend that they pay. The bank that we have is our bank that we've had for over 20 years. Is paying 5.5% dividend quarterly.
Which is awesome, isn't it?
So take your bag of money and buy the bank stocks. Don't deposit it in the bank.
That's very true, isn't it?
So the nice thing about buying the bank stock and not putting your money in the bank is you get the dividend and you also get the growth of the stock as well. So most bank stocks are growth stocks. You can see the charts over time. So we're getting 5.5% on one of the high street banks in Canada. We've doubled our money on the stock purchase itself. Only cost us $10 to buy the stock. And it's a great way to invest your money.
It is.
And it's very safe. If the banks go bust, then we're all in trouble.
We're all in trouble. And the nice thing is that with the dividends, some of them we get monthly and some we get quarterly. And it's always quite exciting, isn't it, to see how much we actually get.
So if you're interested in investing in stocks, maybe take a look at what they call Aristocrat stocks. And those are ones that have increased their dividends and always paid a dividend for a good number of years. So for instance, Coca-Cola is one of those. Most of the banks are. So that's what we would do.
They're kind of rock solid ones, aren't they?
That's right. So let's finish this off just by saying thanks for watching. Thanks for watching our previous video if you haven't already seen that. We did put a link earlier on to retire early.
Yes, we did. And we hope that everybody is staying safe.
Staying well.
This is true.
And we'll see you in our next video.
Bye-bye.
Bye.